Yeah, national income accounting, one of those unnecessarily stressful topics in macroeconomics, right? So today we are just going to try to demystify and to begin, all right, the demystification of this topic. And so here we'll be talking about the income approach. There are three approaches to measuring the GDP income, the national income of a country, right? So you're looking at there is the expenditure approach, there is the output approach or the value added approach, and there is the income approach. So I think for exponential approach is still kind of straightforward. Then the one for value added approach is like I think is the most straightforward, very easy to understand. The one that confuses everybody, both people teaching this thing and those learning this thing, is actually the income approach. All right, so let's begin to learn about the income approach. I'll try my best to simplify this as much as I can, so that at least anywhere you see questions on the income approach, you wouldn't be scared. Again. All right. So, national income accounting is basically looking at summing up the incomes generated from all sectors of an economy in a given year. So, the income generated from the final goods and services produced in an economy, right, in a particular year. So, something like that. Okay, I just try to like, okay, what did you get from here? Just like a household is trying to like look at how much did we make from this, or maybe a company how much do you make from this, from that, from all of that. So like a country is doing the same thing to know its current economic performance, right? And of course, it may also want to compare economic performance to previous periods, or may want to do comparison cross country, like okay, how well am I doing compared to Ghana, compared to Afghanistan, compared to Somalia, compared to the US, France, etc. Okay, I've said it before that there are three approaches to calculating national income or GDP. They are not the same, though. We are going to see that. Um, so value added or the output approach, expenditure approach, that's number two, and income approach, that's number three. All right, so the income approach is just talking about how to measure national income by looking at the rewards, by summing up the rewards to all the factors of production. So that brings us to the question: what are the four factors of production again? Right. So factors of production are basically the categories of items or resources, right, that are used up in production, that are put into productive activities. So we have land, we have labor, we have capital, and then we have enterprise, which some other people may call entrepreneur, right? So land is just talking about natural resources, so like land itself, and then natural resources, including sunshine, including things that are not man-made, right? Even our mineral resources, we just met them. Our forest, our seas, other water bodies, everything is classified under land in economics. And then we have labor talking about the man-made efforts put into productive activities. And then we look at capital, which is talking about no, sorry, labor is the physical and mental efforts that humans put into productive activities. Then capital is man-made resources that are put into productive activities. Enterprise then is the factor of production that organizes all of the factors of production. So it is enterprise, otherwise known as entrepreneur, that finds a problem that consumers or potential consumers are facing and then commit resources to solve those problems. So you identify a problem in the world and you're like, okay, can we solve this? Can this be solved? Yes, and then you have the means to solve it and you have the will to solve it. That is what makes you an entrepreneur. All of us can see problems in anything. If I ask you to talk about the problem of your particular country right now, you probably have a million problems to talk about. But until you've committed resources to address those problems, to also begin to address those problems for the sake of making profit, right, you are not yet an entrepreneur. And so that's that. So we are just basically looking at the rewards to all of these four factors of production. We add everything together and then we arrive at our national income using the income approach. So there are a couple of items that we need to like take note of, right? That we need to sum, remove, whatever, for us to arrive at our national income figure. All right. So, but before then, by the time we add up all of the components of the income approach, what we are going to be getting is the net domestic product at factor cost. All right, so I'm going to talk about the items, but just know that what you're going to be getting is the net domestic product at factor cost. Now, factor cost is talking about the cost of production. right? So a manufacturer, for example, after you've produced everything, right? So like how much did you pay to all of those people that you employed or to all of the resources that you employed? How much capital, how much labor, whatever went into the production of that thing? So you've not yet sold it, so you're just looking at something like cost price, right? So whatever you get at that point is at factor cost. So it is when you sell that's now going to be at market price, right? So the difference between factor cost and market price is just that for factor cost, you've not started. There is no tax yet on the product. Like you are yet to sell the product, so there's no tax yet on the goods or the services that you're providing. So and then those kind of taxes are called indirect taxes, right? But they are looking at just costs incurred, right? So when you're calculating factor cost, you're looking at all the costs you incurred, including subsidies. So if government is paying you subsidy, government is bearing a cost on your behalf, right? So you're like including subsidies, right? But then you don't have anything like indirect taxes, right? But after you've sold the product, then when consumers are buying the products, consumers would have to pay indirect taxes, maybe sales tax, value tax, whatever, consumers would have to pay those taxes. So at that point, we say that you are at market price, right? But I just want you guys to also to just know that whenever you add up all the values for the income approach, you're arriving at net domestic product at factor cost. And net domestic product is actually GDP minus depreciation. So before you attend this class, obviously you would have gone through classes on GDP. So GDP minus depreciation, right, is going to give you your NDP. Okay, so let's proceed. We are going to be solving a couple of exercises after this class, so for us to get acquainted with how to approach questions on the income approach. Now, first we have compensation to employees. So, what does compensation to employees mean? It's just talking about the wages and salaries paid to employees in addition to fringe benefits. Now, fringe benefits that you have here. Fringe benefits are the benefits that employees get as a result of working for an organization, right? So if you're not working, you wouldn't get fringe benefits. All right, an example of a fringe benefit is health insurance. So if your company is giving you health insurance, that's a fringe benefit. It is not your salary, it is not your wage, it's an additional benefit. Now, if your country is giving you bonuses, if your company is giving you bonuses, the organization is giving you allowances, right? All of those things, so they are under fringe benefit. And then your company may also be contributing to your pension fund, which is an example of social security contributions. So when you say social security, you're looking at um, advantages that should be given to people to ensure that they at least enjoy the basic living standards in a given country. All right, so an example, it's not technically defined that, but like it's something like that. So something like unemployment benefits, although it is not a company that will give you unemployment benefits. So a country, like the government of a country may pay unemployment benefits to people. So it's just to ensure social security, to ensure that you are still kind of okay compared to the rest of the citizens in the country. So social security contributions are not the one made by the government, right? Is not to make anybody wealthy. You can't get wealthy through them or with them. So, but it is to make it to at least um, enjoy basic necessities of life. Like for you to be able to find them affordable. All right, but the one we're talking about for organizations, when you work for them, after a while you are going to retire, right? And then at that time you begin to enjoy your pension, right? So the contribution that businesses make into that pension account, right? Because the way it works, in my country, in the organization I'm working for right now, the company pays I think about 50% or 60% thereabout. Then employees pay about 40%, contribute about 40% to the pension fund, which we do not have access to right now until after a couple of years. Whatever, like they know how the whole thing works. So such contributions are also fringe benefits. If I wasn't working for the organization I'm working for now, I'm not going to have that particular advantage. Now there are did I mention others? I've mentioned bonuses, I've mentioned commissions, social security contributions by employers, like health insurance, pension contributions, etc. So what I want you guys to note is that compensation of employees is the family name of every other thing, salary and wages, this, and whatever might also be a fringe benefit. So why I'm telling you that is because you may have a list of items in your national income accounting, which you probably come across before looking for this video. You have a list of items like that, and then which one are you supposed to add? Now, I said compensation of employees is the family name. So once you've seen compensation of employees and a figure in front of it, and you still see salary and wages among your list of items, you see bonuses, whatever, it's none of your business at that point. Just pick the value in front of the family name. Compensation of employees is the family name. So it has already summed up all the values of the salaries, your wages, and your fringe benefits. So you don't need to pick the value for compensation of employees and then go on to start picking each of these values too. It doesn't make any sense. Your answer is not going to be correct because that is going to be double counting or multiple counting, as the case may be. So compensation of employees goes to laborers. So it is a reward for labor. That is why I have an L here. Fine. Now, the next one, you also have government wages and salary. So this is the amount of money that government pays its employees, right? Because government also have organizations, right? So normally speaking, you will just have compensation of employees and then you're done. But if in a particular question you have compensation of employees and you have government wages and salary, so they are trying to like differentiate that okay, this one is for private establishment, the private sector, and then this one is for the public sector. So it is still also a reward for workers. So that's why you also have L labor in front of that. Now next is rent and royalty. So rent is the reward obtained on properties made for lease. All right, properties made for lease. So basically, under factors of production, rent is the reward for land. Okay, so if I give a land out, I know, and I've told you those things on that land, right? I've told you at the beginning of the class. So whatever you get from that is going to come into rent. So that is an income, right? So you also add that to your income and whatever. So how about royalty? So royalty is reward earned for using an intellectual property. So maybe I wrote a book and people are using my book wherever they are using it, right? And then I begin to get reward from it. Even this video you're watching is an intellectual property, right? So if YouTube someday finds me favorable to begin to like monetize this channel and then give me something, I don't know if I can call that royalty actually. All right, but then you wrote a book, you did a literature stuff and maybe a movie or whatever, or maybe songs by artists and you have any royalties on them, it is also an income that is to be added in the income approach. Okay, so after that we have did I put L? So reward for land. That's okay. Land. L for land. So that should have been LD or something. Okay. Then interest. So interest is the reward for financial capital. The reward for making use of a financial capital. So of course everybody knows what that is. So interest is the extra amount paid for haven't obtained a loan, right? So if a business obtains a loan for productive activities in a given year, the interest on that loan is an income to the person who lent the money out. So it is also going to be part of it. Now you also have so we're done. This is reward for capital. This is reward for land. These two they are reward for labor. Reward for enterprise. So we've mentioned it, as we mentioned before, that enterprise is the factor of production that organizes every other factor of production into producing goods and services that are useful for human consumption for the sake of making a profit. Right. So under enterprise, you are looking at there are a couple of them because you are looking at different business organizations. So you have proprietor businesses. So these are businesses where the owner of the business is also the one managing the business. All right. So there are types. You have sole proprietorship, right? You have partnership businesses. So in these businesses, or other unincorporated kind of business that you probably have. When I say unincorporated, I'm looking at businesses that are not joint stock companies, that are not private limited liability company, public limited liability company, and whatever we may have. Right. So any business where the owner is also the manager is a proprietor's is under a proprietorship business. All right. So that's that. So you look at this. So there's one, if you have proprietor's income or income from unincorporated businesses, that is the family name. Right. So if you already have proprietor's income, so that means every business that is not incorporated, right, the value you have in front of your proprietor's income has already covered the rest of them. Right? So you don't need to add proprietor's income, then add sole proprietor's income or partnership income or whatever unincorporated business's income. It's not necessary. So if you've seen proprietor's income, not sole proprietor, please. Sole proprietor is a type of a proprietor's business. So if you see proprietor's income, and then you see this or other unincorporated business, right? Among your list of items, you only pick the family name to the proprietor's income. Well, if you don't see a proprietor's income, you see sole proprietor's income, sole trader's income, partnership income. You add all of those things together, right? In your income approach, they are reward for enterprise as well, unincorporated enterprises, right? So unincorporated, businesses. So it could be called proprietor's income. It could be called income of unincorporated businesses. So whatever the grammar is, right, just know that this is what you are supposed to pick. But if you don't have that, then you pick the element one after the other. Now there are incorporated businesses. Okay, my private liability company, public liability companies. So those ones, what they earn, you call them corporate profits. So it's you don't add for them what you're adding to national income accounting. Their reward actually is profit. It's not the revenue, because revenue minus expenses will give you profit. So if I am earning a revenue, that is not necessarily my income. What's that's not necessarily my reward, because I need to pay out the reward of all of those factors of production that contributed to the success or the failure of this particular business at that time, right? Whatever is left, if anything is ever left, is going to be my reward as enterprise or as an entrepreneur. Okay, so what you're looking at here is just a company profit or corporate profit or whatever way it's put, just profits, not income, right? Profit, please. Now, out of that profit, probably can be broken down into like three things. Out of the profit that is made by the business, right? Because this is incorporated business where the owners are not necessarily the manager. So you are going to be having shareholders here, whether private shareholders, whether for private limited liability companies, you have the you have shares being sold like within, like not made available to the public. And for public limited liability companies, you have those ones putting their shares on stock exchange market where foreigners can come and buy. All right, so in one way or the other, that you own a piece of share or that you own a stock in companies like that doesn't necessarily make you one of those running the companies. Such companies have what do you call it? They have managers. The CEO is not seen as the manager. All right. So in this kind of company, they make profits. So profit is the reward of everybody that is a shareholder, right? So the reward of all of them like that, they're the enterprise, right? Everybody is a shareholder. So now, out of the profit, you pay dividend to all your shareholders, right? So let's say you made a billion naira profit, so you pay about 400 million as dividend to all of your shareholders. Then you have 600 million naira left. The government will say, come. I need a piece of that. The government says, okay, give me 15% of your company profits. So the government is going to be taking about a 50 million naira, and then 400 plus 150, that's 5. So you are left with 450 million. So 450 million, you may decide that okay, we need this to expand the business, we need this to do some other things in the business. So we call that retained earnings or undistributed profit. Retained earnings or undistributed profit. So corporate profit is the family name, right? That now has dividend inside of it as a family member. It has corporate profit taxes, the one that goes to the government, or some countries it might be company corporate income taxes like the CIT or company income taxes. Just know that it is not a tax on their income, but that's just what they've decided to call it according to my present level of understanding, right? So it's actually a tax on their profit. And then you have retained earnings or undistributed profit. So those are the three family members of corporate profit. So once you have corporate profit, do not add the family members again, because all of the family members make up the family. So once you have a figure in front of the family name, which is corporate profit, you do not bother about dividend, undistributed profits, and corporate profit taxes or corporate income taxes. But if you do not have the family name, if you don't have corporate profit, so that means you have to go and look for all of the family members in the long list or short list of items that you've been given. So which would include dividend. If you have, you of course should have dividend in your list. Dividend, look for corporate profit taxes. Right, this is not indirect taxes. A corporate profit tax is a direct tax, right? So direct taxes are taxes imposed on income, wealth, and all of that, properties. So indirect taxes are taxes imposed on goods and services, right? So this is a direct tax. So you have look for this item and what else? Retained earnings, right, or undistributed profits, or I don't know whatever nomenclature they might call it, but you should know from however it must have been stated. Now, this does not mean that you're going to be having all of these three items in a particular question. You may not have the three items, you may have two. So it doesn't mean you should go and manufacture a third item. No, it's not necessary. So just work with whatever data that you have been given. All right, so leaving that, so this is also reward for enterprise incorporate corporate enterprises. This one is talking about, that's the first one, talking about proprietors enterprises, and then we have current surplus of government enterprise. Right, so sometimes government normally does not produce for the sake of making a profit. They might make a profit, so I don't want you to make that mistake that government organizations or enterprises don't make profit. They might make a profit, but the issue is that government doesn't necessarily set out to make a profit. Whatever government is doing, whatever organization the government is putting out there, is to ensure the welfare of the people, right? But then along the line, they may make profits. For example, in Lagos State, you have BRT buses, right? So what it does is it conveys people from one location to another location at a very cheap rate compared to what commercial bus drivers charge or what companies like Uber. I don't know when you're watching this video, there's going to be Uber. So what Uber or is it Taxify or something like that? What all of them are charging, right? So, but then at the end of the year, by the time they do their accounting, they may realize that they made a profit. It's possible, even though they decided they charged people a transport fare that is very, very cheap, they may discover that okay, revenue minus expenses, it remains something, right? So what is left is not called a profit, what is left is called a surplus. So that is why we have current surplus of government enterprises. All right, so that's one too. It's also a reward for government enterprise, which you also add to the income approach in case you have it as an item in your question. Now, there are transfer payments. Now, the issue with national income accounting is that you do not add payments made for goods and services that are not currently produced. That is, you're only looking at goods and services that were produced like in a particular year, fresh goods and services, right? But transfer payments are not made for fresh goods and services. They are made for goods produced in the past period or goods not produced at all. An example is scholarship. So if you are given a scholarship, what did you produce? Nothing. You may say that okay, I wrote an exam. Like who cares? Maybe you should have left the exam. Like what did you actually contribute? What did you produce? Nothing. You wrote an exam, then government transferred, or maybe a business gives you a scholarship. So that is the transfer payment. It is not added to the to national income accounting. Unemployment benefits, of course, we are looking at somebody producing something in the current period and then you're unemployed. Whatever the government is giving you, then or maybe a child support or whatever, those are transfer payments. They are not to be added to national income accounting. Whatever approach you're using, they're not to be added. All right, so you have gifts. Gifts are not to be added. They are not for currently produced goods and services. How about pension? Pension is for work done in the past. Right, so I can't be working now and be collecting pension now, right? Except maybe I'm not working the same line of business, right? What I'm when you get a pension is because you've worked in the past and then you retired from that particular line of business and then you're receiving your pension. So the pension you're receiving at that time is a transfer payment because it is not for currently produced goods and services. But then you may now didn't I mention pension at the beginning? So what I mentioned here is employers' contribution to your pension accounts or employer's contribution to your pension fund. You are still working with the organization at that time, right? So what the employer is contributing to your pension fund is still an income to you, right? So that is why it is classified under compensation of employees, the employer's contribution to the pension fund, right? But once you just have pension in the list of item, that is a transfer payment. You don't add it, like you just let it be. Okay. Then we have so when you add up all of this, you're getting NDP at factor cost. NDP at factor cost. But then the question may say calculate national income instead of saying NDP at factor cost. So that's why I wrote this one here. National income is actually your net national product at factor cost. Like this is it. So until you're able to get your net national product as factor cost, you can't see you've gotten your national income. So if the question just says calculate national income, it's actually expecting to get your net national product at factor cost. Right. And I said by the time you add up all of this, I'm not speaking about stock appreciation, so let that be. By the time you add up all of this, is there something else? Yeah. By the time you add up all of this, all you're getting is net domestic product at factor cost. So what you have to do to net domestic product at factor cost is for you to add net income from abroad, right? That's what you're now left to add. Net, or what is called net factor payment, or net factor income from abroad. What does that mean? It is basically the difference between payments made to foreigners or resources owned by foreigners used for production or used to produce goods and services in your economy, right? So you are looking at you are deducting that from your citizens' assets abroad, payments made or reward obtained from your citizen or their asset, abroad. So let's say I'm working in Jamaica, right? And then as a worker, I earned let's say 1.5 million. I don't know what they spend in Jamaica actually, but let's say dollars. But I earned 1.5 I earned $1.5 million last year, 2023, right? $1.5 million. So that is actually income received from abroad to the Nigerian economy. I'm in Jamaica, right? I'm in Jamaica. I earn that amount of money. But when Nigeria is doing its income accounting, it is going to add that, but it's going to classify it under income received from abroad. That is income paid to a citizen of mine that is abroad, right? So when you have that, then you subtract it to who are the Jamaicans in Nigeria. That's a simplistic example. So if they are Jamaicans in Nigeria and then they worked, they got some reward, they probably had properties, they probably had companies that made profits, there's wages, there's whatever. So whatever income those ones earned as Jamaicans working in Nigeria, that is payment made to foreigners. So what you just do is payments made to your citizens abroad minus payments made to foreigners in your domestic economy. Right, that will give you a net factor income from abroad, your net factor payments. Or let me put it simply, another way it could be done is income received from abroad, that is income paid to your citizens abroad, income received from abroad minus income paid to foreigners in your own country. That gives you net factor income from NFIA, or net factor payment, or net factor payment. I think net factor payment, that's just fine. So what you just do is after getting your NDP as factor cost, of course, when you add up everything, I said you're getting FC straight, it's at factor cost. Add up everything, um, you what did I say? So add your NFI to it. That gives you your NNP as FC. So once you have your NNP as FC, it is automatically your national uh income. But before jumping to that as well, sometimes we may have what we call statistical discrepancy. So what does it mean? These are statistical errors in data collection. So let's say while statisticians were busy collecting data on income, different incomes in the economy, they probably made errors in one place or the other. So you call them stats. Those errors, they will have a value for them. So you call them statistical discrepancy or statistical errors. So it's not every time you are going to be having these errors, or maybe just errors. Maybe I don't know if you can just have errors, but I think statistical errors or statistical discrepancy from what I've seen so far. So if you have things like that, it's just saying that okay, um, your accounting using the three approaches, outputs, whatever, they are meant to be equal, right? So if you're calculating and they are not equal, so that means there must have been a statistical error. So if you're giving statistical error in your calculations, what you just do is you add the error to your NDP as factor cost. So like while trying to get your NNP as factor cost, you must have gotten NDP as FC first. So you add statistical discrepancy to NDP as factor cost, right? So you're adding um, net income from abroad, you're adding statistical discrepancy if you have those things in your data set. And then for stock appreciation is just talking about the increments in price of current stock. The increments in price of current stock. So it's not as if you have new stock. So what you would add to your calculations would be new stock. But since there is what do you call it now? If you don't have a new stock is representing current production. In the income approach, you don't have stock because it is not an income to anybody. But if you have stock appreciation, so what we do is that we deduct it. So from our NDP as factor cost, you are going to remove it because it is just increase in price of current stock of goods or maybe shares or whatever in an economy at a particular period of time. So like it's going to be bloating economic performance. So it will make it look as if your economy did better than it actually did. So if you have stock appreciation in your list of items, you remove stock appreciation. So how do we convert the income approach to national income? So you have add everything together, get your NDP at FC, add statistical error, add net income from abroad, remove stock appreciation, and then you're going to be getting NNP at factor cost. Yeah. So yeah, um, that's about that. So in the next video, we are going to be looking at a question that we can solve, maybe one or two questions that we can solve to get one of these things. So I think I've differentiated between market price and factor cost, right? So fine. So see you in the next video when we begin to solve problems on income approach. Bye. Take care.